Hello, you are watching a series of interviews on the AIFC activities. Today we are having a special guest, Mr. Akber Khan. Mr. Khan is an acting CEO of Rayan Investment. Welcome to our studio.
Thank you. It's great to be here.
We are happy to welcome you here.
Always a pleasure to be back in Astana.
First of all, we are interested in the award-winning funds, Rayan GCC Fund and the Rayan Qatar ETF, which are managed by the ARI. And what do you think sets these funds apart from others in the market? And what were some of the biggest challenges in their development?
Well, Nargis, thank you so much for asking the question. Let me just for the viewers explain what they are. So Al Rayan GCC Fund, obviously from Al Rayan Investment, invests in the GCC, so the Gulf Cooperation Council. That is 6 countries in the Gulf, so Qatar, Bahrain, UAE, Saudi Arabia, Kuwait, and Oman. That's the GCC. So the fund was established in 2010, so it now has a track record of more than 14 years. And it's an interesting fund because it is an absolute return fund, which it's a multi-asset fund. So it can invest both in public equities, in Sukuk, and in cash. So it's a Sharia compliant fund because Al Rayan Investment is owned by an Islamic bank in Qatar called Masraf Al Rayan, second largest Islamic bank in Qatar. So everything we do is Sharia compliant. But the interesting thing about this fund was it was launched in early 2010. So when we were developing it, it was 2009. We just had a slightly large event globally, financially. And to be honest, the investors that we were approaching, neither they nor us knew that whether over the next 5 years they should be investing in a fixed income fund or an equity fund. I mean, after the financial crisis, is there going to be a rebound, or is the world going to be damaged for a long time? So this was the first fund that we launched as Al Rayan Investment, the asset management business. Effectively, it was the product that opened our doors for business, the first product for our clients. And so what we kind of ended up in the terms of the product development is to have a multi-asset fund, which are now more common and more popular in the last few years. We did this 15 years ago almost. And the fund can decide, the fund managers have the discretion to decide what proportion of the fund is in equities or fixed income or cash. It can be 100% of any of them. There's no maximum or minimum for any asset class. So that was pretty interesting, and it's an absolute return fund, so it's not benchmarked to anything. And so AIF, at the time that we launched it in Qatar, which is where it's domiciled with the Qatar Central Bank, and the founder is Masraf Al Rayan, our parent. We're the fund manager. It was the first fund in our market which gave investors access to the GCC region. Over the next few years and across the region as well, there's now many more GCC funds. It's one of the largest, it goes up and down, but if not the largest GCC fund, Sharia compliant GCC fund. Most of its life, it's been largely almost 80-90% plus an equity fund. However, in 2015, 16, 17, when oil prices fell to $30, $40, and the GCC economies were in difficult places, the equity allocation dropped, and it was much more equity, fixed income and cash to protect and enhance investor capital. So it's been a very interesting fund to manage, but it's been an also very rewarding fund for investors. It pays a dividend twice a year. You know, the annualized average annualized return since inception is almost 9% net of fees. So despite economic cycles, oil price cycles, geopolitical and regional instability in the GCC, all manner of things happening. There's a lot of growth to access in the region, and this fund does a great job of accessing it, and we're very proud. We're very proud of the product. It's the largest, it's one of the largest mutual funds in Qatar. But the larger mutual fund in Qatar is the Al Rayan Qatar ETF, which you mentioned. That is an ETF which was really it was our first ETF. We were otherwise an active asset manager with active asset management products. This was our first foray, if you like, into the passive world, into an ETF. And this ETF tracks an index of Sharia compliant Qatari equities, and it's one of the largest Sharia compliant equity ETFs in the world, actually. and one of the cheapest for emerging markets. So that when you're investing in an ETF, fees are of great importance to investors. And the expense ratio of this ETF is 50 basis points, 0.5%, which is much higher than it would be in a developed market, but much lower than many much larger ETFs, even in emerging markets. The cost of doing business in emerging markets is a little bit higher. So we're very proud of this ETF as well, because it put us and Qatar on the map. It's the largest ETF in the GCC, regardless of Sharia compliant or not, but one of the largest Sharia compliant ETFs in the world, equity ETFs in the world.
So it looks like, despite being started without knowing what is ahead of the funds, one thing is certain, that they are now successful products.
Well, luckily, yes. And the ETF was launched in the second quarter of 2018. So it's a bit younger than our GCC fund, but it's had very, very good investor reception by the investors. And a lot of when we launched the GCC fund, and this is some of the conversations that have been happening around AFD as well, is about the importance of investor education. When we launched the GCC fund, there was a lot of need to educate the investors as to what the investment case is for the GCC. Why should you invest in the GCC? It wasn't seen as a established geography or asset class. And that's been an ongoing process. Similarly, for the ETF, in the Gulf, at that time, there was examples of bad ETFs which had failed or been delisted. There wasn't really a successful ETF. So again, it required a lot of education. So across the asset management world globally, it's not about Qatar or Kazakhstan. To have success, you clearly need to educate the people who are your potential customers.
So how would you assess educational level of investors now comparing to the 2018? When it was quite poor, maybe, yeah?
It was zero. I mean, it was very poor because there was no awareness at all. It's certainly a lot better now. It's not, it's still, I wouldn't say it's mainstream. There's only 2 ETFs in Qatar. The third one is on its way by another asset manager. So it's certainly better than it was. And the education is not just for the investors. The education was also for the ecosystem, for the service providers. Even though we had global companies who were the service providers, the custodians, the administrator, the external auditor, et cetera, for the fund, for the ETF. And globally, they do service ETFs. Their regional offices had never serviced an ETF before. So there was an education process even for that. The biggest education process was for the regulators. When we started our ETF, there was no rules. The regulator didn't recognize what an ETF was. So the first part of the process was to help with, and this is what we love doing, is to actually help develop the plumbing, the infrastructure of the market. So you're building infrastructure, which then other people can piggyback and use afterwards. So we helped effectively the rule book, and I think looking at where the rest of the Gulf is, we actually think that the ETF rule book in Qatar is probably the most sophisticated of any of the markets in the region, because there are ETFs in other parts of the Gulf now, but we think that the regulatory environment within which they operate is not as easy as the one ours is. And I think partly the reason is, this is sort of praising ourselves a little bit, is because so much, and praising the regulators to be honest, is because so much of the regulations were written in consultation with the industry, in consultation with the service providers, in consultation with all the stakeholders. So we ended up with a really strong document.
Actually, praising is fine when it's deserved. So yeah.
Thank you.
Yeah, and also it looks like all parties should be educating themselves constantly in order to be successful.
That's right.
Yeah.
That's right.
So thank you very much for detailed explanation.
Sure.
And our next question is, what key trends do you see shaping the future of Islamic finance globally? And how can institutions like AIFC stay ahead of these developments to enhance their competitive edge?
Great question. So one of the things about Islamic finance, whether we're talking about banking, insurance, asset management, any aspect of it, is it's in tremendous undersupply globally. Mm-hmm. Some parts of the world it's more undersupply than others, but everywhere it's undersupply. And just to to give a big macro data point, to just put some numbers on it, a quarter of the world's 8 billion population is Muslim.
Yeah.
A lot of global studies over the last several years estimate that the total contribution of Islamic finance to total finance markets, and this is in a big aggregate way, it's not just talking about funds or asset management, it's talking about all financial services products, is 2 to 3%. So clearly, there is a huge undersupply. It's not going to become 25% because the average income, let's say, or the average wealth of maybe those 25% is not the same as the rest. But even if that 2 or 3% was to become 10, that doesn't seem stretched in the context of 25% of the population. But that means that we have to triple or quadruple from where we are today globally. So this is why Islamic sort of finance, all aspects of it, is so exciting, whether you're a bank or an asset manager or an insurance company. The AIFC is in a fantastic position because the AIFC has, particularly from an Islamic asset manager or Islamic financial service provider's perspective, is in a region where the undersupply relative to potential demand of Islamic products is very, very high. The undersupply is very high. Which means that if you are providing these products, there's a great opportunity, not just in Kazakhstan or in the AFC, but in the broader region. And if somebody wants to access the broader region, if you are an international player, then there's really only one place to come and do it from, which is the AIFC and AFSA, because of the great work that you guys have done, and actually in a remarkably short time. Often there is a benefit from coming to the party later because you get to learn what other people have done right and done wrong, and you can then accelerate your own development. And I think that's a lot of what's happened here in Astana. And so the beauty of the AIFC is that you have a platform which I wouldn't say is perfect. No platform is, but it's certainly getting better and better, and ticks more and more of the boxes that a international financial service provider would want, but also then is a place where there is demand for those products. So that's why I think it's great. And so, look, talking about it specifically, I think because the traditional incumbents, which is basically in most cases banks and insurance companies, Kazakhstan is not alone where the traditional incumbents are not sort of pushing the way or leading the way or not in an urgency to access this market. Why? Because they make more than enough return and sufficiently fat margins from their traditional conventional business. So if a Sharia-sensitive customer is looking for these products and services from their bank who they get all of their other products from, they probably aren't going to be getting all of what they want. So what they'll probably end up getting serviced by is some sort of a technology provider, i.e. a fintech. So a technology platform which sells them Islamic financial products, banking, insurance, asset management, whatever that may be. So for AIFC, the thing to capitalize on is not to say, how can we have 10 Islamic banks set up here, which I hope they do, but it's how is it that we can position ourselves as the place for fintechs, be they Islamic or non-Islamic, to come and base themselves here, because there's going to be room for fintechs to do conventional finance. Clearly, globally, that's the way. But in a market where there's a demand for Islamic finance and the traditional banks don't have the same urgency as the customer does, then the simplest and quickest and most nimble way to access those customers is through a technology platform. So that really would be a great way for the AIFC to capitalize on that. And the advantage of that is that if you can develop a technology platform to access customers in, say, Kazakhstan, there's absolutely no reason why that platform cannot access customers in the broader region. Because you don't need to go and build physical infrastructure. You need regulatory approvals, but that is a much easier process than to have to go and build branches all across the region. So that's, I think, would be a key shortcut in trying to attracting that market. And the other thing that I would say is that given that the government has clearly expressed interest in wanting to develop this industry and develop Islamic finance, in many countries, what you see is that the government issues, for example, a sovereign sukuk. And most people at the time, when the first time this has happened, don't know what a sukuk is. But that's the point of it. It's like the government is almost advertising to the domestic audience to say, this is important enough that we've done it. So people start learning what it is. But it's a signal to the financial services community outside to say, we take this seriously enough to actually have issued a sukuk. And the reason why that's doable is because most governments are issuing debt periodically anyway as part of the normal course of business. The only thing is that this is Islamic as opposed to conventional. And so it would just be the same thing that they would do normally, but with a Sharia angle to it. And that in itself starts developing the industry, because you then need the Sharia structuring, you need expertise, you need local understanding for what exactly has just happened. And that starts helps to build the ecosystem as well. So that is clearly not the only way, and is by no means a prerequisite, but as a signaling, it's been done in the UK issued a sovereign sukuk, Hong Kong issued a sovereign sukuk, not markets you typically associate with Islamic finance.
Yeah, absolutely.
But they did this for precisely this reason.
Oh, that's great, actually. And also the main point is also to focus on the fintech, rather than it's great to bring as many banks as possible, but the best way is focusing on the fintech.
The quickest way, the quickest way, and probably the easiest in the beginning, but to fully access the market, you will need the non-fintech players as well. If we are going to talk to an institution, a pension fund, an insurance company, another corporate, we as an asset manager, they're not going to want a fintech solution. They're going to want to deal with an actual asset manager who they can touch and feel and see. So that's a quick way of dealing with maybe the individual consumer, whether they are investing $1,000 or $1 million, but that's not really the way you would access somebody who wants to invest 25 or 50 or $100 million.
Yeah, I see. And also you brought up Sukuk, and also interesting countries that we wouldn't think otherwise, that are implementing the Sukuk regulated products, I would say. And we do have questions related to that. With the increasing interest in Sukuk and the Islamic capital markets globally, how can AIFC position itself as a leading platform for Sukuk issuance and trading? And what strategies should be implemented to attract more Islamic finance activities to the region?
Wow, that's a lot of questions in one, Nargis.
Yeah.
You ask difficult questions.
Yeah.
Okay, let's try and unpack that one at a time.
Okay.
First of all, there's a lot of competition. This is, there are 2 or 3 very dominant centers right now where, so for example, giving a live example, this week or last week, we as Al Rayan Investment, because we have an asset management business and we also have an investment banking business where we do a lot of, where we help companies raise equity capital, i.e. through the stock market, listings, IPOs, and we also help issuers raise debt capital, i.e. do Sukuk, whether that's for banks or governments or whoever else. So we literally last week advised a company in Qatar who issued the first ever Sukuk in Qatari Riyal. Previously, all issuers in Qatar who had issued Sukuk was always in US dollars. So this was the first ever one in local currency. And that was listed in London with UK regulations, because that is the one that is recognized globally by investors without having to think twice, without having to question, without having to say, what is this? I've never heard of it. Immediate credibility because it's listed in London. So if you want issuers to list, for example, here, initially it would have to be a dual listing. So the issuer would list in London and in the AIFC.
I see.
But so when you list in London, because all the service providers, in particular the lawyers, who are a key part of any Sukuk issuance or bond issuance, can do the documentation quickly, and you want them to do it quickly because the longer it takes them, the more they charge you. So as an issuer, you're conscious of this. To allow that to happen, the rules and regulations in the AIFC for the issuance of, let's say, Sukuk, would need to have been pre-tested with gap analysis and other things to say if an issuer was to go and do the listing in London, what would they need to do? What are the rules? What are the requirements? What's mandatory? What's optional? Cost, process, etc. And then they come and do it here. How different is that process? And if it's very different, then the issuer is not really going to want to do it here. And in Qatar, it is different, which is why this issuer didn't do it in Qatar. We are working on another issue, which is going to be dual listed in London and in Qatar. But that is taking longer for the reason I've just explained. So that is one way to try and solve it, is to say, let's not reinvent the wheel. We know there are certain very big established centers. London is one of them. It's not the only one.
Yeah.
Let's just, and everyone likes it, recognize it, knows it, trusts it. The advantage that AIFC has is already, if we're looking at London, is you use English law. You've already ahead of the game over there. In Qatar, we don't use English law. We use Qatari law. But in the AIFC, you use English law. So that would be a way so that when a potential issuer is saying, I want to do a dual listing, it's not seen as, I have to do all this scary stuff in the AIFC, which I don't have to do otherwise. Or there's certain requirements or certain limitations, certain restrictions, is relatively seamless. And so when an issuer then sort of, you start seeing as an investor, more and more dual listings, then you start getting used to it. And your internal compliance and legal and other people say, yeah, AIFC is great. We like it, trust it, no problem. Like they say, there's no questions about London or New York or wherever else. That is how you kind of fast forward that process of making AIFC become a credible, established domicile. And the simplest thing, as I said, to repeat, is not to try and do things from scratch, is to just take what's already there and adapt it.
So in a way, a cooperation with the trusted organizations, might lead to being in a leading position.
Yeah, so I mean, you work with international law firms, and you say, you literally hire them to say, if your client was going to issue a Sukuk and list it in the AIFC, how difficult is it? You're a law firm, would you recommend it? And they say yes or no. And if they say no, then you say, why not? And then they'll tell you all the reasons, all the problems they have. You fix those problems so that then the next international law firm, when an actual issuer comes, then you're not going to have those problems. So the first thing is to fix them. The second thing is to then advertise and publicize how easy it is to come and use the AIFC as a platform. Again, education.
Yeah, I see. Yeah. Education is a key everywhere. Yeah, thank you again for this extended answer. And also, you did mention some trends in development of in the investment industry. Yeah. So among those trends, what is the most exciting and or concerning things right now for you?
You ask lots of really difficult questions, Nargis. Wow. Okay. So what are some of the interesting trends? I guess short-termism. A lot of investment managers tell their clients, tell their investors that they're investing with a medium to long-term horizon. But very often they are much more short-term because of market volatility. They find it harder to stick to their longer-term discipline. I would say investment shortcuts, where as an investment manager, you see a lot of excitement about a particular asset class or a particular security, even if it's within your area. And even though you may not have done all the work that you should have, you get sucked into investing in it because it's just the thing that everyone's talking about. And that's often how bubbles form, and you end up buying something and it's not, didn't perform as well as you did because you took a shortcut by not going through your rigorous investment process, for example, because you feel you didn't have time and you're panicked into buying, you don't want to miss out. And similarly to that, I would say is what's sometimes described as tourist investors. So, I mean, it doesn't apply to us because we don't have that flexibility, frankly. But, if let's say you're a global macro investor or a hedge fund who has flexibility, and typically you focused on a certain geography and a certain asset. Let's say typically you've invested in European equities, as an example, public equities. But suddenly there's a whole lot of excitement as to what's happening in the latest IPO on the AIFC or in the Gulf or in Malaysia or wherever else. And there's a lot of hype around it, and you start investing. That is what would be described as a tourist investor, that you're not really dedicated to know exactly what that is. You're just there for the ride. You're there just for the holiday. To hopefully you'll make a little bit of money. And that's kind of you didn't do enough work. Sometimes those investments work, sometimes they don't. So not all of these trends are new. Some of these have been going on for a while, but I think these are some of the practices which bring bad name to the investment industry. There are thousands of phenomenal investment managers who do what they do and consistently have amazing results. But given the extreme competition, it's often for returns and the pressure from investors and the pressure when you telling people on a daily, weekly, monthly basis what the returns are, and the investors say they are long-term, but they ask you why you've had a bad week or a bad month. So that short-termism is on both sides. So the asset managers or investment managers are reacting to the what the investors are doing, what their clients are doing. So I think that has led to some practices which, in a global context, could be better. In terms of opportunities, the democratization of investments. So ETFs are an example where I can access an asset class with very little money. So you and I can access it, and so can a pension fund. You and I are investing $1,000 and the pension fund is investing $1 billion. We both get to access the same asset class. So the ETFs are now a $12-13 trillion industry. So the last decade has been incredible. I guess the newer version of that is tokenization, where again you're taking the concept is the same. You're taking large assets and you're able to distribute them into smaller ways, and the tokenization lends itself to technology, and asset managers who are able to embrace using technology for their distribution are gonna do a better job. Particularly over the next 2 or 3 decades, as more and more of their clients over the next 2 or 3 decades have grown up where their entire life is on a phone. A 50-year-old client today did not grow up with their life on a phone. But in 20 years, a 30-year-old client, everything needs to be on a mobile device. So the asset managers who don't embrace technology, as well as others, will still have a niche, but they will not be able to access as much of the market as they do today because of how practices and habits will change. So I think that's a great change, because essentially it is getting the industry to be more responsive to the needs of their customer, which is the investors, and also it's beneficial for the industry because once you are able to embrace the technology, you actually have much quicker time to market for your products and services. You actually end up saving costs and being able to access a much larger audience, perhaps across geographies or globally, than you would have otherwise in your more traditional distribution platform. So the distribution aspect is a huge topic in itself in terms of how asset managers will be best able to distribute, depending on what their focus is, institutional, individual, etc.
So the technology is making it more accessible for everyone, yeah?
Yes.
Also, you told that it's very important here to thoroughly investigate, research everything rather than following some advertisement and just become a tourist investor, yeah, as you said. That's a great point, and actually I think it brings us again to the education. Everyone shall educate themselves before investing money. Yeah,
sure, it applies both for the professional investment managers. When I was mentioning it earlier, I was referring to the actual asset managers, the professional investment managers who end up with these practices because of pressure from their clients. But it as you rightly say, it applies to the actual individual, if you're an individual or even institutional investor as well, because just because your friend invested in something doesn't mean it's the right thing to do. It could be, but that in itself isn't necessarily the right answer. I mean, I'm always reminded of a story. There was a bank in Spain that in the early parts of 2000, very large bank, was always under pressure from its shareholders because they weren't investing in US real estate. And at that time, US real estate was booming. And a lot of banks were finding ways of investing in real estate and structures and vehicles to take advantage of this. And the board used to keep saying, we don't really understand, so we're not doing it. And then in 2008, the financial crisis came and wiped out the subprime crisis, triggered a whole global financial crisis and wiped out those investments. And then this bank suddenly looked like a hero because they didn't succumb to the pressure that so many other global institutions had done so. Some of the biggest institutions in the world, some of which don't exist anymore because of what happened, and they stuck to their guns. So it took 5, 6, 7 years for them to be proven right. So it's not just about resisting pressure for a month or 2 or 3. It takes a huge amount of strength to be able to say no for so long.
Yeah, it's a great example.
And you know, that's but you have to be firm in your process.
Yeah, I see. Yeah, that's a great point. And also our next question is, with your extensive experience managing GCC public equity and the global Sukuk portfolios, can you share some insights into the investment strategies that have been most effective in these areas? I think you partly covered, answer for this question, maybe some specific strategies if you could mention.
So you mentioned the GCC, and you know that's it's very interesting, and it's not the GCC alone that it has these characteristics. It's a lot of frontier or emerging markets where one of the ways of differentiating, in my view, between a developed or advanced capital market and an emerging one is the quantity of information that is disclosed. So in the US, in Europe, in the earlier part of my career when I was involved in European equities, people used to be providing software to filter the vast amounts of information that were available related to a sector, an industry, a market, whatever else, because you have financial newspapers, TV channels, websites, huge amounts of mandatory regulatory disclosure required from companies. So the amount of information, you're drowning in information. So there is an industry to help investment managers filter it to focus on what's important. On the other extreme, you have in the frontier or emerging market, an absence of information. I mean, it's not just the companies, also in developed markets, you have a huge amount of government data that's published on a daily basis. You know, if you think about US data releases, how many times the whole world is focusing on US data releases. There's a lot of data released, not just the ones we focus on, but even all the other stuff around it. In emerging or frontier markets, sometimes the government data is released, let's say it's GDP or whatever else, for a period that's 1 year ago. So if you're waiting for that information, you're not really going to be able to make proper investment decisions. So you need to know what's happening on the ground. But the amount of information, whether we're talking about Kazakhstan or Central Asia or Southeast Asia or parts of Africa or or Latin America, i.e., where you have more emerging markets, or is far less. And so the investor that does best is the one who's able to have the least incomplete information. Let me say that again. So in the developed markets, you have almost complete information. You have too much. In a typical frontier market, you have incomplete information. So the person who has the least amount of incomplete information, i.e. who has the most information, it will still be incomplete, will be winning. You know, in a world where everyone is blind, somebody with one eye is going to be winning. So in a way, this is probably the easier way of saying it. And the reason I'm telling you this whole long story to answer your question is that the biggest advantage that we found in how we manage money in our emerging region, which is the Gulf, is that the information disclosure to the average investor in a listed equity and the information disclosure to the average investor in the fixed income market was different. And all of them was less than what would be done elsewhere. So what we found is that because the majority of investors in our region don't do multi-asset class, they only do equities. So they know what equity investors are told. But the same company, when it issues a bond or a sukuk, tells bond or sukuk investors completely separate information or far different information in their prospectus. But if I'm only doing equities, I don't look at that. Equally, if I'm only doing fixed income, I don't look at what's happening on the equity side. So we were able to take advantage of, if the way we explain it or describe it is information arbitrage, to be able to take information here and here from both asset classes and bring it together to actually have more complete information about a company or about a sector or about a country. And the more information you have, the better investment decision-making you make, the better decision-making you make in any aspect, whether it's investments or in the rest of your life. So for us in the investment world, your commodity, your currency is information. And essentially using this multi-asset approach, we're able to harvest more information and sew it together to build a more detailed narrative or what's happening at a company level, an industry level, or an economic level. So I think that I'm talking about the GCC, but would apply equally to probably any emerging capital market.
Yeah, so that's the great example of least incomplete
least
information.
Incomplete, yes.
Yeah, that's great actually. Thank you very much, Mr. Khan, for being today with us and sharing all those insights.